you've been following crypto, you know that big price moves don't always come from within the crypto space itself. Sometimes the biggest shifts happen because of decisions made by the Federal Reserve. And those decisions don't just affect Wall Street. They can ripple through everything from stocks to real estate, and yes, even Bitcoin. That's why investors pay close attention to what the Fed says and does. In this video, I'm going to break down the March 19th FOMC meeting, what Jerome Powell announced, what it means for the economy, and most importantly, what it could mean for your crypto investment. Because here's the thing, markets don't just react to what the Fed does, they react to what they expect the Fed to do. And if those expectations don't line up with reality, prices can move fast. My name's Kareem and welcome back to the Crypto Code by ICN Talks. Stick around because by the end of this video, you'll have everything you need to know to stay one step ahead. You cannot afford to miss this. On March 19th, Jerome Powell took to the podium and announced that the Federal Reserve would be holding interest rates steady at 4.25% to 4.5%. Now, on the surface, that wasn't particularly surprising. The markets were largely expecting this outcome. But what really caught investors' attention was Powell's announcement that the Fed would be slowing the pace of its balance sheet reduction starting in April. So what does that actually mean and why should you care? Essentially, if interest rates hold steady, what does it signal? By keeping interest rates unchanged, the Fed is essentially saying, we're not ready to make any bold moves just yet. This kind of decision often reflects a cautious stance. The Fed is closely watching the economy and waiting for more data before deciding its next move. In simpler terms, Powell and his team are choosing to sit tight rather than risk cutting rates too early or raising them further without clear evidence that inflation is fully under control. It's like they're standing at a crossroads waiting for the fog to clear before choosing a direction. And for investors, this steady hand approach is a bit of a mixed bag. On one hand, holding rates steady avoids the kind of panic that aggressive hikes can create. On the other hand, it also means the Fed isn't feeling confident enough to start cutting rates, which is what markets, particularly risk assets like crypto, would love to see. Now, Powell's announcement about slowing the balance sheet reduction is where things get interesting. Since the middle of 2022, the Fed has been reducing its balance sheet through quantitative tightening, or QT, essentially letting its bond holdings shrink by allowing them to mature without reinvestment. This process pulls liquidity out of the financial system, which can tighten financial conditions and weigh on asset prices. Up until now, the Fed has been allowing up to $25 billion in Treasury securities to roll off its books each month. But starting in April, that cap will be reduced to just $5 billion per month. In simple terms, imagine the Fed's balance sheet like a giant sponge that holds money in the financial system. Over the past year, the Fed has been squeezing that sponge by letting $25 billion worth of Treasury securities expire each month without reinvesting that money, effectively removing cash from circulation. Starting in April, the Fed will reduce that squeeze to just $5 billion per month. This doesn't mean they're adding cash back into the system, but they're slowing down how quickly they're draining it. Less money leaving the system means financial conditions could loosen slightly, making it easier for businesses to borrow, investors to take risks, and markets, including crypto, to find some breathing room. Now, Powell was careful to downplay the significance of this, saying the change has no policy implications and shouldn't be seen as a shift in their broader monetary strategy. But here's the thing. Markets don't always take the Fed's words at face value. When the Fed slows QT like this, it's often interpreted as a soft pivot, a sign that they're becoming more mindful of liquidity conditions. Investors may see this as the Fed subtly preparing to ease financial pressure if economic data starts showing signs of strain. Even if Powell insists that this isn't about the policy, the reality is that reducing the pace of QT can help improve liquidity, and that's something risk-on assets like crypto tend to respond positively to. Beyond those key decisions, Powell's remarks painted a picture of an economy that's still facing some challenges. Number one, GDP growth is projected to come in at 1.7% for 2025. That's lower than the 1.9% forecast back in December. This suggests the Fed is expecting economic activity to cool slightly. And number two, inflation. Inflation, while easing, remains a concern. Total PCE inflation, which is the Fed's preferred measure, is sitting at 2.5%, while core PCE, which excludes volatile food and energy prices, is at 2.8%. That's still above the Fed's 2% target, which explains why Powell isn't rushing to cut rates just yet. Number three, Unemployment remains low at 4.1%, but the Fed projects it could rise slightly to 4.4% by the end of the year. In short, Powell's message was clear. Inflation is cooling, but it's still sticky enough to keep the Fed cautious. They're not ready to declare victory just yet, and that's why aggressive rate cuts aren't on the table for now. So what does this mean for crypto? For the crypto markets, this creates a bit of a balancing act. On one hand, the fact that the Fed isn't hiking rates further is a positive. It means they're not tightening conditions any more than they already have. On the other hand, Powell's decision to hold rates steady instead of cutting suggests that they still see inflation risks, which could limit any immediate upside for risk assets. But the most intriguing part is the slower QT pace. While Powell downplayed it, markets may see this as a sign that the Fed is preparing to support liquidity if the economy shows signs of slowing. Historically, when liquidity improves, crypto tends to benefit as capital flows back into the riskier assets. So, while Powell didn't deliver the bullish signal that crypto traders might have been hoping for, he also didn't close the door on a more supportive environment down the line. The key takeaway, markets are now in a wait and see mode. And that means investors should be keeping a close eye on future economic data and Powell's next move. In simple terms, I think we're going to be trading sideways for a while. So what's the key takeaway from Powell's March 19th speech? Here are the 3 key insights. Number 1, interest rates are holding steady, which offers some relief but signals the Fed's caution on inflation. Number 2, balance sheet tightening is slowing, suggesting liquidity conditions may improve, which is bullish for risk assets like crypto. And number 3, uncertainty is high, meaning Powell's next move could surprise markets. Staying informed is your best edge. All right, let me pull up the screen and show you what's happening in the markets. All right, so if you want to stay up to date and know when things are happening, the best website for you is the federalreserve.gov. So this is a place where you can see when the timelines are for the next meetings. For example, in January this year, you can see that the first one happened January 28, 29, and here you can get the press conference and the transcripts. And the one that just happened this week that we're talking about in this video is the one on March 18, 19. So every time this happens, we'll do a recap on what the Fed has said, and then we can at least analyze the markets and see what's going to happen next. But usually you'll see a week before these dates, you'll see that the market starts to react because they expect something that Powell will say. For example, interest rates will go down or interest rates will go up. And then as soon as the announcement happens, we'll see either the markets go up if it's something that's positive, or it'll go down if it doesn't meet the expectation. So this is a great place to find this and stay up to date with everything that's going on. Next up, what I wanted to show you is you can also see the recent balance sheet trends, and you'll notice something really interesting here. So what does this mean, right? So this is the Federal Reserve's balance sheet. And what does it mean if it goes up, and what does it mean if it goes down? So when we look at the key indicator here of how much, it's basically a key indicator of how much money the Fed is injecting or pulling from the financial system. And if you see it trending upwards, like you see, let's go back to 2008, for example. This is a great example. This is when obviously the financial crisis happened. We saw the banks collapse and the governments stepped in to support the economy. So in this case here, we see it in 2008, for example. What this means is it's quantitative easing. So there's more liquidity being pushed into the market. So number one, you get the government buying more assets, so they buy more treasury securities or mortgage-backed securities. They increase liquidity, and they make it easier for businesses and consumers to borrow because they're injecting more liquidity into the market. And so what we saw here was a huge jump in liquidity, and that's why they had to ease the markets and make it easier for companies and businesses to survive during that time. Then we saw it trending upwards over a long period of time. And then when COVID happened, we saw a huge spike again in QE. And what happened here was the government pumped more liquidity into the markets. We saw a bull run in crypto because there's now more money in the systems for people to invest in riskier assets, and crypto got a lot of that as well. So we saw Bitcoin really pump during that time. Now, what the Fed has been trying to do since 2021 to 2022 is start implementing quantitative tightening. And what that means when you see it trending downwards is the opposite effect. So if the chart is moving downwards, it means the Fed is either selling assets or they're allowing securities to mature without reinvestment. They're removing liquidity from the financial system. This makes borrowing more expensive as credit conditions tighten. And we saw that with the increase in the interest rates, becomes very difficult to borrow money, or becomes very expensive to borrow money. And so that helps cool down the economy. It helps bring down inflation. But we've been seeing this since 2022 is basically this downward trend. And what we're saying from the last FOMC, right, on March 18, 19 with Powell, is that we're not seeing a complete shift to QE where they're going to pumping liquidity in, but they're reducing the quantitative tightening, right? So that's what they're doing. They're reducing it from $25 billion a month to $5 billion a month. So it's still in a downward trajectory. It's becoming less than before. So this is a great place to check on what's going on. Obviously, if we start to see this chart go back upwards, that's a positive sign for, riskier assets, including crypto, because we're seeing more liquidity being pumped into the market. So that's what I wanted to show you today. So the key takeaways: the Fed is, if it's going up, the Fed is adding liquidity. If it's going down, the Fed is removing liquidity from the markets. Okay, moving on. And we'll talk about this later on in the video, but this US debt clock is insane. I mean, this is live counter of how much debt the United States has accumulated so far. $36 trillion, and it's just going up crazy. I think they just added this Doge clock recently. So the Department of Government Efficiency has put in this real-time savings objective, and you can see how much they're trying to save. So it's really bad. And I think with Trump coming into power now and trying to fix this, we're starting to see a lot of, it's going to be tough because their interest rates right now is so high that it's really cutting into their budgets, and the United States is really in a bad position right now. So all of this ties in together to what the Fed wants to do. It ties into global markets, and we'll talk about that later, but I found this really interesting. And if you wanted to keep an eye on how things are progressing, you can, it's all live and you can see it on this website, usdebtclock.org. So moving on, the FOMC, and you'll see this as it happens over and over during the year, especially in the crypto on X, on all of these different influencers in the space. Everyone's waiting for these announcements because they want interest rates to go down. They want liquidity to be pumped back into the system. They want to see the economy getting better, growing, because all of this relates to riskier assets, including Bitcoin and crypto. So these are funny memes just saying that we're all waiting for those announcements, and you tend to see market activity right before, like a week before the announcements. And here's another one I found funny. Like, you see the markets as soon as he starts speaking, it either goes red or green, and in this case, obviously, it's just trading sideways. But it wasn't that, and it was a lackluster of an announcement. Let's put it that way. So how are the markets reacting? To be honest, in the past week, we're seeing some green across. We did a video about Pi. It's down 50% since a week ago, which is sad, but it is what it is. But everything else you can see is some green. I guess investors are a little bit more bullish on the direction that the Federal Reserve is going into, which is great news for our industry altogether. So we wanted to showcase that. Moving on, I wanted to show you quickly the ICN.live platform that we've built. This is an excellent resource for you to use to stay up to date with the latest news in crypto, in AI, in gaming. It's a great resource and a great platform. I use it to check out what's happening with Bitcoin specifically and the market. So we can see today actually the market greed and fear index is 31, which is better than before. It was really low. I think it was at 1015 last time we checked, but things are getting a little bit better. I think we're starting to feel like the Fed is moving in a positive direction, even though it's not completely in pushing liquidity into the markets. It's still, being cautious, but it's definitely moving in a better direction than we were, let's say, a year or a year and a half ago. So we're seeing the market starting to price that in. So Bitcoin at $84,000 seems good. Ethereum is now below 2,000. And yeah, we're just keeping an eye on everything. Moving on, I wanted to show you some interesting news. On ICN.live, you could see this. This is Tether's $33 billion investment into US Treasury bonds. This all ties in together because stablecoins are becoming very, instrumental in adoption and mass adoption across crypto. And the fact that these stablecoins are buying US Treasury bonds is an indicator that the US dollar will stay strong, but there's definitely strong sentiment in the market as well. So just wanted to show you some of the great news that we have on this platform. You definitely subscribe to the newsletter, stay up to date. This is the best platform that I've seen so far. Go check it out and let me know what you think. Moving on, I wanted to also show you there are ways to stay, up to date with the Federal Reserve. They have an X account. You can follow that. They always announce right before the press conference is going to happen. They announce what the press conference is, and they also share the transcript. So it's a great place to follow. There's also FOMC alerts on X that you can follow, and then just get hourly updates on what the Fed is up to, which is also a good way to stay ahead of the game. Moving on, Virtual Bacon. I also follow him, and he does a very macroeconomic assessment on what's happening. He also talks about what's happening with the Fed, and he has a good pulse on the news. So I try to stay up to date with him as well. Moving on, I wanted to just show, I was following this and I saw this. So markets have entered into oversold territory and investors are looking for a catalyst to shift sentiment. Will Powell's remarks give him the confidence to buy this dip? Let's see if he delivers the boost the market needs. Everyone is speculating before the press conferences, and you see this time and time again. And then based on the expectations, you start to see the price of Bitcoin and crypto, or even the stock market, get priced in based on what they expect the news to be. And you'll see that a lot. So obviously they would like to see more QE. They would love to see more liquidity into the markets. And if that doesn't happen, or if interest rates go up, then it affects the markets negatively. And then finally, breaking, FOMC did nothing. Yippee. So at the end of the day, it felt like it wasn't, we didn't really get the delivery that we wanted from that press release. But again, if you look at the fine details, you will notice that it is getting better. They are reducing the amount of QT, which is a positive sentiment. So let's get back to the video. So why does the whole world pay attention to the United States Federal Reserve? And what tools do they actually have to influence their economy, an economy that impacts markets across the globe? So the Federal Reserve has two primary mandates: maximum employment and price stability. To achieve this, the Fed wields two powerful tools. Number one, interest rates. Raising rates makes borrowing more expensive, which slows spending and cools inflation. Lowering rates does the opposite. It encourages borrowing and economic growth. Number two, balance sheet management, which is essentially quantitative easing and quantitative tightening, QE and QT. So during QE, the Fed buys bonds to inject liquidity into markets, which stimulates asset prices. On the other side, QT involves selling bonds or letting them mature, reducing liquidity. Over the past decade, the Fed has navigated an economic roller coaster. In 2020, faced with the COVID-19 crisis, the Fed launched aggressive QE, ballooning the balance sheet by over $4 trillion. Since mid-2022, they've shifted to QT, shrinking the balance sheet by $2 trillion. This constant push and pull directly impacts stocks, crypto, and commodities. But here's where things get serious. The US debt situation has spiraled out of control, exceeding $36 trillion, a number that has serious implications not just for the United States, but for global markets as well. This debt isn't something that appeared overnight. It's the result of years of deficit spending, low interest rates, and massive stimulus measures introduced during the pandemic. While those strategies may have kept the economy afloat during difficult times, they've left the US with a mountain of debt that's now impossible to ignore. By the way, if you're liking what you're hearing, then let us know by smashing that like button and subscribe to the channel. Crypto moves fast, so ping the notification bell as well to make 100% sure you don't miss our next crypto update. Why does this matter now? In previous years, mounting debt often felt like a problem for future America, but today, the numbers are simply too big to overlook. Just the cost of servicing this debt, paying interest alone, is skyrocketing, especially now that interest rates are higher. The more money the US spends on debt payments, the less it can spend on crucial areas like infrastructure, healthcare, and education. Now, under the Trump administration, the pressure to tackle this debt is front and center. Trump's renewed focus on financial responsibility has led to some bold moves. And interestingly, it's not just traditional policymakers driving the conversation. One of the most unexpected developments has been Trump's collaboration with Elon Musk through the newly established Department of Government Efficiency. The idea behind this department is simple: bring in some of the smartest minds from the private sector to identify waste, inefficiencies, and outdated processes across federal agencies. Musk, known for his ability to cut costs, innovate, and rethink complex systems, has been tasked with helping to streamline government spending. His involvement aligns with his belief that bloated bureaucracies and excessive red tape slow down progress. Musk has long criticized government inefficiencies, famously clashing it with regulatory bodies in the past. Now, he's taken that mindset and applying it to reduce waste and improve spending efficiency at the federal level. Say what you want about Elon Musk, but stepping up like this, I respect it. Most people are quick to point out what's wrong with the government, the inefficiency, the waste, the corruption. But when someone actually steps up to try and fix it, suddenly they're met with criticism from every direction. That's exactly what Elon is facing right now. Since taking on this role, he has faced relentless backlash, and it's coming at a cost. Tesla's stock has dropped nearly 50%. All because he decided to take on a challenge most people wouldn't touch. And he's not being paid for this. There's no personal gain, yet he's still choosing to step into one of the most politically charged environments imaginable, knowing full well that the media, politicians, and even some investors would turn on him. And this isn't the first time Elon has taken massive risks. He's revolutionized electric vehicles, transformed space travel, and built billion-dollar companies from scratch. Now, instead of playing it safe, he's taking on one of the most inefficient systems in the world: government spending, because he believes it's worth fixing. He could have easily avoided all of this. He didn't have to risk his reputation, his businesses, or his time. He could have stayed focused on Tesla, SpaceX, and his other ventures, continued making billions, and kept out of politics altogether. But instead, he's willingly walked into a firestorm, not because it's easy, but because he sees a broken system that needs change. Elon didn't need to join this fight, and it's not winning him any favors. Yet here he is, pushing forward despite lawsuits, media attacks, and critics trying to tear him down. And the reality is, whenever someone tries to disrupt the system, there's always pushback. Markets panic, stocks dip, the media spins a narrative. But over time, things stabilize, and history tends to reward those who are willing to take bold risks for the right reasons. Fixing something as big as government waste isn't going to happen overnight. It's going to take time, resilience, and a whole lot of patience. But doing nothing, that guarantees things stay broken. Elon doesn't have to be perfect, and he won't get everything right. But at least he's stepping up when most people wouldn't. And that's something I respect. I'll stand with people who take risks for the greater good, even if it's unpopular. Because real change doesn't come from playing it safe. It comes from those willing to challenge what's broken, no matter the cost. If Elon's efforts to reduce government costs and inefficiencies succeed over the next 4 years, the economic impact could be significant and positive. By streamlining spending, the US government would have more room to manage its massive debt without relying solely on tax increases or aggressive borrowing. A more balanced budget could stabilize the economy, which tends to create a more favorable environment for risk assets like crypto. Lower government spending could also reduce inflationary pressures, giving the Federal Reserve more flexibility to ease interest rates, a move that historically benefits crypto markets. Finally, improved economic efficiency often leads to stronger investor confidence, which encourages capital to flow back into growth sectors, including digital assets. So if you're serious about crypto investing, don't ignore the Fed's impacts on markets. The connection may seem complex, but as you've seen, the dots are all there to connect. Understanding macroeconomics isn't just for economists. It's for anyone looking to have an edge in this volatile crypto landscape. If you made it this far in the video, thank you. See you next week.